An IPO is commonly understood as a debut. A company rings a bell, its stock ticker flashes on the exchange, and it officially becomes a public entity. But that bell is just the final output. The actual public offering is a heavily regulated, mechanical process of price discovery and risk management. Take the Draft Red Herring Prospectus, or DRHP, for Xtranet Technologies. Right on the cover, it states the objective: raise up to 19,000 lakhs in capital. This presents an immediate logistical problem. At the time of filing, the company is asking the market for exactly 19,000 lakhs, yet neither the exact price per share nor the final buyers are known. The solution to that paradox is embedded in three specific regulatory mechanisms listed on the same cover page: the 100% book-built process, the ASBA protocol, and the exact equity allocation blocks for institutional and retail investors. We are going to reverse engineer these three legal phrases to expose the physical financial systems that actually govern the IPO. The next slice guarantees a minimum of 15% of the equity for non-institutional bidders, typically high net worth individuals or corporations. The final block ensures at least 35% of the total issue is reserved for retail individual bidders. Examining the 50% QIB tranche closely, SEBI mandates further carve-outs. The issuer can allocate up to 60% of this block to anchor investors. Anchor investors must commit a minimum of 1,000 lakhs a full working day prior to the public opening. Their early participation locks in baseline demand, signaling stability to the market. Within that anchor allocation, exactly 1/3 is specifically reserved for domestic mutual funds. The non-institutional tranche operates with its own internal mechanics. It splits unevenly based on application size. 1/3 is reserved for bids between 2 lakh and 10 lakh rupees, while the remaining 2/3 captures applications exceeding 10 lakhs. This rigid mathematical matrix balances the equation. It guarantees broad retail access while simultaneously securing the heavy institutional capital required to float a 19,000 lakh issue. With the allocation matrix set, the system needs to determine the price. This is where the 100% book-built mechanism comes in. In fixed-price sales, the company dictates the exact cost. In book-built issues, a range is provided, and market demand determines the final clearing price. This chart visualizes the engine's boundaries. At the bottom is the floor price, the absolute minimum valuation the issuer will accept. Above it sits the cap price. SEBI mandates that this upper boundary must be at least 105% of the floor price, but cannot exceed 120%. During the bidding window, institutional and high net worth bids populate strictly within this constrained band, typically clustering toward the upper end of the valuation. The algorithm identifies the peak clearing demand, the precise point where enough bids exist to sell the entire offering. This resolves into the final issue price. Retail individual bidders do not have to guess where this price will settle. They are granted a unique bidding privilege. They can select the cutoff price option on their application. This means the retail investor agrees upfront to pay whatever final price the institutional demand establishes. The book-building engine effectively outsources the complex work of valuation to professional institutions, while allowing retail investors to anchor safely to that established consensus. If an IPO is massively oversubscribed, the system faces a critical logistical hurdle, processing billions of rupees in excess bids without triggering immense counterparty risk or managing millions of individual refunds. The regulatory solution is application supported by blocked amount, or ASBA, executed through self-certified syndicate banks. ASBA changes the core architecture of the bid. When an investor applies, no actual capital is transferred to the issuer. Instead, the investor's bank acts as a verified node in the network. The application simply instructs the bank to freeze the required funds. The capital remains entirely within the investor's own checking or savings account, generating zero settlement risk in transit. The system waits until the allocation matrix and final price are locked. This triggers what the DRHP calls the designated date. On this date, the bank debits only the exact rupee amount corresponding to the successfully allotted shares. Any unallocated funds are instantly unblocked. By replacing the physical transfer of capital with conditional digital permissions, ASBA eliminates the systemic settlement risk of a high-volume public offering. The DRHP is a meticulously engineered closed-loop system. The rules for allocation, pricing, and capital transfer do not operate in isolation. They execute sequentially as a single operational model. First, anchor investors commit their capital, locking in early stability and providing a demand baseline on the price graph. Next, the book-building engine processes institutional demand within the rigid 105 to 120% boundary, mathematically calculating the final clearing price. Once the price is locked, the SEBI matrix automatically stratifies the available equity, determining exactly which institutional and retail bidders receive shares. Finally, the ASBA protocol executes the settlement, debiting only the precise funds needed for allotted shares and instantly releasing the rest. The output of this synchronized process is exactly what the initial document promised: a fully capitalized, publicly traded entity. Understanding an Indian IPO requires viewing the Draft Red Herring Prospectus as a set of mechanical instructions. It is the compiled source code that securely translates raw market capital into publicly traded equity.